You're welcome to my channel. In this video, we are going to be introducing our course unit called Elements of Taxation. So in this video, we are going to be looking at the introduction to Elements of Taxation. So we shall start by defining what a tax is. A tax is a monetary charge. Monetary, it comes from the word money. It's a monetary charge imposed by the government on persons, entities, transactions, or property to yield public revenue. Yeah, that's what we call a tax, monetary charge. You should note that. Then it's imposed by the government. Then paid by persons, entities, transactions, or property to yield public revenue. So the main aim of taxes is to yield public revenue. Yeah, but where payment is not monetary, or it's not in terms of money, taxes are referred to as contributions from persons and property. It's levied by the government for the support of the government and all public needs. And that is what we call a tax. So let's look at the basic characteristics of a tax. Yeah, the characteristics that differentiate a tax from other forms of payments, even though they're all paid in monetary form. First is that a tax is a compulsory payment. Like you have to pay it, you have no choice. When they tell you you're supposed to pay this amount, you're supposed to pay it. There is nothing you can do. So it's a compulsory payment. Then secondly, taxes are paid to the government. The mandate to administer and collect taxes lies with the government only. Yeah, this is an exclusive mandate to only the government. So it's the government that is supposed to collect the taxes. Then there is no immediate direct exchange for the tax paid. Once you pay the tax, it's not that they give you something in return immediately. You might get something in return, but in the long run. Yes, so there is no immediate exchange for the tax paid. And those are the three basic characteristics that differentiate a tax from other forms of payments. First is that a tax is a compulsory payment. Secondly, taxes are paid to the government. And thirdly, there is no immediate direct exchange for the taxes paid. Let's look at the different taxpayers, the different groups that pay tax. We have individuals like persons. Yeah, then we have groups, a group of people, then other legal persons. So those are the taxpayers that we have, the individuals, the groups of individuals, and then other legal persons, like maybe a company. A company is a legal person. Yeah. Let's now look at taxation. Taxation is considered to be the process of administering a tax system within a given state or jurisdiction. Yeah, the process of administering tax. It's what we call taxation. But in other words, taxation is the process by which charges are imposed on individuals or property by the government authorities to raise funds for public purposes. So the second definition comes from the definition of a tax. We said a tax is a monetary charge imposed on individuals or property by government to raise revenue. So taxation is the process by which charges are imposed on individuals or property by the government authorities to raise public revenue. Then a tax system refers to a legal system of assessing and collecting taxes. It talks about the tax liability, it talks about who is supposed to pay the tax, who is supposed to collect the tax, when is the tax supposed to be paid. It talks about the procedures for ensuring compliance to tax payment. Yeah, and that's what we call a tax system, a legal system for assessing and collecting taxes. Let's look at the different rules of taxation. Yeah, what does taxation do? Like, how does it help us, or how does it help the country? Yeah, rules of taxation. First, it raises revenue for the government to fund its day-to-day operations, like paying salaries to civil servants Also funding for long-term projects like construction of schools, hospitals, roads. Yeah, taxation brings in that money that the government uses for the day-to-day things, the things that they want to do to construct roads, hospitals, and other things. Yeah. Then it can be used to regulate demand and supply in an economy in terms of inflation. Taxes may be imposed for the reason of fighting inflation. If direct taxes are imposed on incomes, there will be less disposable income, leading to a fall in the demand for goods. This will consequently lead to a fall in prices. So once the demand is high, the government can decide to increase on the direct taxes to reduce on people's disposable income. Then when the demand is low, the government can decide to reduce on direct taxes to increase on people's disposable income. Another role of taxation is that it encourages the development of local industries, and protect them against foreign competition with a view of providing employment and saving foreign exchange. And this can happen by imposing high duties on competing imports. You impose high taxes on competing imports in order for you to protect the local industries or to encourage the development of local industries. Then taxes encourage export of goods and services in order to make them more competitive in the world market by reducing or removing taxes on exports. Once you reduce the taxes on exports or you remove taxes on exports, it will encourage people to export. And this will help to increase on the number of exports, or it will encourage the export of goods and services in the country. Taxation protects the society from undesirable and harmful products, and this can be achieved by imposing high taxes on such products and industries. For example, excise duty on harmful products like cigarettes and beer, and environmental levy on second-hand vehicles. Then taxation helps to achieve greater equality in distribution of wealth and income. Equal distribution of wealth and income, and this can be achieved by imposing a progressive tax on the incomes. Like the tax that you pay increases with the increase in your income. That's what we call progressive tax. So it means that the rich will pay more tax compared to the poor. So it will help to achieve greater equality in distribution of wealth and income. And lastly, taxation discourages dumping. Dumping is that act of selling a commodity abroad at a cheaper price than at home. When you take it to another country, you sell it at a cheaper price. That's what we call dumping. Such goods may discourage the development of local industries. Since you bring your products and sell them here at a cheaper price, you're discouraging the development of local industries since they are cheaper than the locally produced commodities. So in order for us to overcome this problem, taxes may be imposed on the dumped commodities so that their prices can increase. So taxation helps to discourage dumping. We've looked at tax as a source of revenue to the government, but except tax, the government can get revenue from other sources. And let's look at the other sources of government revenue. We have the non-tax revenues, e.g. fees, licenses, motor vehicle registration, borrowing internally, like using treasury bills, or borrowing externally from World Bank and other organizations. Then the government can also get revenue from sale of government enterprises. Then it can get revenue from devout partners in form of grants. It can get revenue from aids and donations from other countries. It can also get revenue from interest on investments, and lastly, it can get revenue from rents from these properties. So this has been the introduction to elements of taxation. Thanks for watching. Don't forget to subscribe, like, comment, share with your friends, and watch my next video. We shall be talking about the principles or canons of taxation.